the assessment to be redone, which is quite possible. Commissioner can determine that CBDT circular applied in this case, 15 crores exceeded, assessing officer forgot, 263 I will apply, case has to be referred to the TPO, assessment can reopen. This happened in the case of Ranbaxy. Then another situation, your transaction value is within 15 crores. Good, there was no CBDT circular, assessing officer did not refer, so nothing happened, good. But still, going by Fab India, there is a risk. Because in Fab India, what the tribunal said was, there were transactions, assessing officer did not deal with the transactions in the assessment order. So he did not apply his mind. So having not applied his mind, then it is it's prejudicial to the revenue, and therefore it held commissioner was right in using 263 in reopening, in asking the assessment to be redone. So just to tell you that don't think that your past assessments are closed, possibly some assessments are waiting to be opened. Yeah, the usual time limits will apply, like 147 time limit or the 263 time limits will apply. But if even the time limit is surpassed, then of course you are safe. So then let me not talk about Aztec because it's now quite settled. Earlier people used to take an argument, after all I am getting a 10A, I am an SEZ unit, anyway my profits are exempt. So what is the big trouble in assessing me, determining a TP adjustment, finally I am entitled to, why will I even think of shifting my profits? But it's now kind of settled that incentive to shift profits is not really a criteria, and you could have an SEZ unit. If there is a TP adjustment, you will claim tax holiday, but on the TP adjustment you are supposed to pay tax. There is no tax holiday for the TP adjustment that happens to you. So even an SEZ unit can still be visited with a TP adjustment and result in tax. Coca-Cola is an interesting decision, Punjab and Haryana High Court, because it brought out the facet that it need not necessarily be a transaction that happens outside India. In this case, Coca-Cola had one of the group entities of Coca-Cola had a project office in India. It was dealing with one Indian entity, Indian group company of Coca-Cola. So basically this was a transaction that happened within India, payment was made in rupees. So no talk about any foreign exchange. It was not a foreign transaction as you and I understand. It was a transaction that happened within India. But nevertheless, court said, look at the meaning of an international transaction. Transaction between two parties, at least one of whom is a non-resident. The Coca-Cola's project office is assessed with the status of non-resident. So even though the transaction is happening within India in rupees, it is an international transaction within the meaning of TP, had to be reported, 3CEB, TP adjustment, all that risk will certainly flow. So these are all broadly cases wherein rulings, mostly AR rulings, have held if the transaction itself is not subject to tax. It's slightly different from the position that we saw earlier in the case of Aztec where tax holiday. But here it's saying where the transaction itself is not subject to tax, then there is no fun in applying TP provisions. So it said TP provisions don't apply. Right? This was cases like capital gains transactions which were basically exempt for one reason or the other. Then broadly these principles here, again they have said if there is an international transaction, if it is referred to TPO, then assessing officer cannot again sit in judgment over that. So if TPO makes some adjustment, does not make any adjustment, thereafter assessing officer cannot say, okay, I will also use 40A, sister company, I will try to make some disallowance. That is not possible. It is out of your ambit. So then here, there is an interesting case which actually happened in Chennai. Super profits. This company, poor thing, it had huge profits. So it was safe on TP provision. It had some 40% margins as compared to an ALP, which was accepted by TPO at, let's say, 15-16%. Again 15-60%, the company was earning high profits. So the TPO added a line, the company is earning very high, extraordinarily high profits. Assessing officer may want to look at it. Assessing officer took the clue. He started applying 10A provisions. He said under 10A, since the entity was an EOU, he said there is shifting of profits from abroad to the entity, and therefore I am using 10A provisions. So this matter went on appeal. So just another facet which we might think as long as I am good above ALP, no issue, but there are, department is thinking otherwise. Okay, 5% adjustment. The one quick issue which I want to touch upon, as you know, 2009 October, the 5% adjustment amendment happened. Earlier it was like it was at the option of the assessee, 5% adjustment was available, and there were a number of rulings which have said it is an automatic adjustment. If the ALP is 20%, you are at 10%, the adjustment will not be to the extent of difference, but you can bring down the ALP from 20 to, let's say, 15. So the adjustment will be only to the extent of 5%, the difference of 5% and not the full difference of 10%. So broadly this was a settled principle, given that there are a number of rulings on this issue. But later on in October 2009 this was amended, saying that the wordings are amended, effectively meaning that the assessee will not be able to claim it as a standard deduction in all cases. Only if he is within this 5% range, he will be entitled to this adjustment. So now the question then came up, since this amendment happened in October 2009 and assessments are still going on, assessment year 8-9 just ended, so can I still apply to old assessment years? Can I say this amendment, even though it happened, it will apply only prospectively from assessment year 10-11 onwards? So this was litigated, and broadly we've had some rulings early on, SAP Labs, Technimount, UE Trade. So number of rulings came up favoring assessee, saying that this will not be retrospective, this will be only prospective. But recently there have been other rulings as well. Hyderabad bench, for instance, Deloitte, Delhi, there was a decision saying that 5% adjustment will not be available, it will be retrospective. Now this issue is getting trickier, and when a request was made to the Hyderabad bench for referring to a third member for constituting a special bench, this was rejected by the Hyderabad bench, unfortunately, and therefore this issue continues to be litigative. I think I'll, with the paucity of time, I'll just stop it here. The other issues are broadly on royalty and loans, which in any case is available. I'll be happy to take any questions.
3 questions will be taken up totally.
Yeah, perhaps this question is not entirely based on logics, but if there is a transaction like transfer of assets from associated enterprise to an enterprise in India, now what would be the basis of arriving at an arm's length price? Is being transferred as a second-hand machinery, so you don't find some database, maybe some patented machinery which is being done only by that particular holding company. So what would be the basis of arriving at an arm's length price? Is the assessee free to choose his own method, or he can say that, okay, it's transferred at a cost from my parent company, something like that, or is there any specific way in which it should be done?
Okay. So as you know, there are 5 prescribed methods, and there have also been rulings that you will have to use only one of the 5, and you cannot go beyond, and you cannot say none of the method is applicable, so therefore I am not using any method. Is also not possible. You should somehow find out one of the methods to be most appropriate method. That's what the tribunals think, and therefore they have said you should use one of the 5 methods. So coming to your question, so I mean, if you look at the methods broadly, cup should be the applicable method. But if you look at cup, what does it say? The price of an uncontrolled comparable transaction, comparable uncontrolled transaction. So in your case, second-hand machinery, it's next to impossible to find any third party selling similar machinery, identical machinery. So what you do, next step, get a valuation certificate, which in any case you would have got for the customs purposes. Then the question is a valuation certificate acceptable as a comparable uncontrolled transaction? Based on precedents, yes. Some of the cases, like there was this case of Intel Asia, where in a case of business sale to a within the group, sale of business, the valuation certificate was held to be the basis under CUP method. And talking of CUP, there are, broadly, the tribunals have also started accepting the reality, saying that forward contract prices could be accepted, industry averages broadly could be accepted. Having said industry averages, they have also recognized Like in the case of shipping, there are index numbers that are available, which are again based on actual shipping rates charged between third parties, and there is an index number, indicative number, which is available in, let's say, a Thomson report comes out, and you're using that as a basis. They have recognized that may not be clearly a third party transaction, but nevertheless it is acceptable as a cup. So this is also evolving in terms of accepting other things. Okay. Okay. So that brings us to another aspect of cup, wherein whether a customs valuation is acceptable as a cup. Some of the rulings have actually accepted customs value, like for instance, import of edible oil, import of coal, export of coal. It's next to impossible to find out third-party transactions because it's done very secretively. So what you do, customs database throws up some amount of data, but it will not have party details. It will not even tell you which party has sold to which party. So you will not be able to even conclusively determine if the transaction that you are looking at itself is a related party transaction. So there are these difficulties. You will not have details whether what is the calorific value of coal, for instance. Is the coal comparable to me? Can I make an adjustment? Data visibility is very low. But that's how things are happening. And recently there are a couple of decisions which have said customs valuation per se cannot be accepted. That was in a slightly different context, because it rightly recognized customs have a different objective, income tax has a different objective. Customs want to increase your purchase price, income tax wants to reduce your purchase price. So there are two authorities operating at cross purposes, and therefore they said customs valuation may not be the right. So it's a difficult situation, but nevertheless, I think in the context that you have mentioned, an independent evaluation certificate which would have been provided for the purpose of customs to the customs authorities is normally recognized as a appropriate comparable. Yeah, that's a good question. So what happens is transaction, as I said, is pretty wide. If you look at the meaning of transaction, it says which has an impact on the assets or profits of either enterprise. So therefore it's pretty wide. Technically it will even cover an equity investment. But then the view is that if the equity comes in for the purpose of subscription, by way of subscription money, initial subscription money should not be covered. But later on, when it is pumped in, it should be reported, and therefore once it gets reported, it will be considered for the purpose of 15 crores. It may not have an impact at all, but nevertheless, on another score, if the entity later on decides to sell it, and for the purpose of its capital gains computation, whether there is overvaluation, undervaluation at the time of original investment, can be an aspect. And the other tricky point is, how do you determine can an RBI valuation be enough? Again, there are no clear answers in the sense. Let's consider the context of interest. When interest is paid, people used to argue it has been allowed by RBI, it is within the ceiling rates prescribed by RBI, and therefore you should not question from a TP perspective. But rulings have said RBI is looking at something else. It's looking at conserving foreign exchange, but TP is concerned about something else, and therefore merely because something is approved by RBI does not mean that your transaction is at arm's length. So therefore we are back to square one. RBI maybe as a supplementary support is enough, that RBI has accepted this thing, but nevertheless you should also consider looking at other supportings like having an independent valuation, bringing in other methods.
The case of 10A 10B, let's say 10A 10B case is referred to the TPO, and the assessee voluntarily changes the transfer pricing method, makes an enhancement. Can he claim the 10A 10B deduction on the enhanced income?
In fact, this is a straight case of iGate solutions, wherein the assessee did precisely that. What he did was he offered it suo moto, and the issue went up to court, saying that when there is an adjustment, can 10A be available on the adjustment? because the TP provisions also read in a manner that if there is an adjustment on account of transfer pricing, 10A deduction will not be available on the enhanced value. But the Bangalore tribunal said, if you look at the provisions, it says if the assessing officer makes an adjustment. So in this case, if you are making the adjustment, you are entitled to take 10A deduction. But if the assessing officer does the same thing, you are not. So, but then having said that, the other aspect is, even to claim 10A, you will later on have to bring in so much of foreign exchange. So therefore, I think it practically translates into invoicing. So it's not merely an off-book adjustment that you make. It has to be followed up by invoicing, because to meet the practical requirement of bringing in the foreign exchange subsequently. So unless you bring in the foreign exchange, 10A deduction may still not be available.
Yeah. During 1 year, a company is rendering services to a foreign entity, and at that time they are not associated enterprises. In the subsequent year, the Indian company takes over the foreign company, so they become associated enterprises. But in both the years, if they are rendering services at the same prices which have been fixed, can the previous year's data, when they were not associated enterprises, be used as a comparable data?
Yeah. Answer is in two parts. So first of all, whether previous year data can be considered as a comparable for current year. Broadly, I mean, even if you look at the rulings, they have said previous year data cannot be considered as comparable unless there are factors to indicate that those influence the determination of arm's length price. So you will face a challenge even in using past year data, even if it was as late as March data. You will find it difficult legally to use it as a comparable. It brings us to the next question. So during the year, sometime in the middle of the year, the change happened, and therefore are the transactions conducted before the takeover, or can these be accepted as comparable transactions for the transactions which I did subsequent to the takeover? If you look at the provisions, it says 92A subclause 2 says at any time during the year. When it defines AE, it says any of these 12, 13 conditions at any time during the year. So if one view is any time, so therefore the transactions carried out throughout the year become AE transactions. That is one view. The other view is, let's look at it practically. What if I was an AE earlier, and during the year I came out, we became third parties. So what will you do? Will you still consider these transactions as AE transactions? Obviously not. We have become third parties. I have divested. I have come out of this company, and we have become third parties, and therefore, subsequent to divestiture, these should be treated as third party transactions. Similarly, prior to my acquisition, unless there are factors to indicate that I had any control on the other company, I think it should be possible to say that transactions prior to acquisition can still be considered as comparable transactions for that year. But in the subsequent year, you will have challenge in terms of finding comparables in subsequent years, because you will not have your own transactions and you will have to look elsewhere. Can you repeat the question, sir?
If there's a transfer pricing issue, will the assessment be made by the regular assessing officer or by the TPO?
Okay, to answer it simply, both of them can make. So assessing officer is required to refer the case to the TPO if the transaction value exceeds 15 crores, which means TPO only will make the TP assessment order, and assessing officer is simply required to make the assessment blindly following what the TPO has done. If it is below 15 crores, assessing officer has an option to refer it. He is not mandated. If he finds it necessary and expedient, he can refer it. In that case, if he chooses not to refer, then he can do the assessment himself. He can do the transfer pricing assessment also himself.
Just one more question. We were discussing about the data collected by the TPOs, and you were saying that TPOs from Bangalore, Hyderabad, or wherever, I mean, they call for data from so many other companies. Could it happen that you being an SSC from Chennai, or say take a current place, you also given data to that TPO wherein your own assessment is happening in your own city? How does this data flow between the TPOs, because your data could be used by another TPO for another thing, and on the same hand, that company's data could be used against you or whatever. I mean, how does this data flow?
As a matter of fact, it is happening. The department is using the data, calling for data wherever they have the data already. They are using the data, pulling it, sharing it within themselves, and in cases they are also giving it to the SSE. Like as I said, they are not giving the whole data, but they are giving part of the data, like scanned copies of notices, scanned copies of replies, or being given in CDs. Apparently, they are traveling in the soft mode between various locations, but certainly this is happening, and this is also posing a concern for companies in terms of the secretive nature. I mean, confidentiality, whether their business details are getting out, is also an increasingly matter of concern. Thanks a lot.
Thank you, Shivam. And this is the session where we had less of interaction because of the time span in which we had, but still the questions are most welcome, and you can post your questions to the email ID of sirc@icia.org. It will be forwarded to the speaker and we will get the replies from him. That is the assurance we give for not having a longer interaction session. And on behalf of each and every one of you, I take this opportunity to present a small memento to the speaker. Thank you. May I now invite the course director C.A.V. Jagadishan onto the dais. The introduction to the speaker is the excitement of the participants today. That is, for the past 4 days, what you have been enjoying is a concentrated thought processes put into action, and this particular concentrated thought process is being put into action because of the initiative taken by none other than the course director C.A.V. Jagadishan. The satisfaction and that of the feedback is seen in your faces rather than expression of other forms of words, which is that what we are realizing in the fellowship hours when we are in the coffee time and other times. Else, all the credit for this particular refresher course goes to the course director, and he is none other than that of C.A.V. Jagadishan, son of Vaidyanatha Swami, who has did his schooling at Sri Ramakrishna Mission High School, T Nagar, and graduated from Loyola College, securing first prize in the BCom degree examination, and completed the Chartered Accountancy in November 1955. Completed the Chartered Accountant articles in 56. That is, before that he has completed the final examination, and since then he is in practice. He is elected to the Central Council of the Institute of Chartered Accountants of India for 3 terms, 1973 to 1982. He was the chairman of Taxation Committee, besides all standing committees, wherein he brought many proactive measures and initiatives for both the students and members. And he has conducted courses on taxation at all India levels at many places including Nepal, presented several papers on taxation at various conferences and seminars. He is a lecturer in taxation for MCom classes at the University of Madras for over 20 years, and he was with our institute for the CA students at SIRC for over 20 years. He is the youngest brother of Honorable Justice V. Balasubramaniam, and also his niece, Honorable Justice Chitra Venkatraman, is a sitting judge of the High Court, who specializes in taxation per se. And he is having 2 sons. Prabhakar, who is a chartered accountant, is present among the audience here, and Balachandar, who is the second son, who is an advocate. With this, I present before you once again, the course director, already being presented to you in the inaugural session.
Good evening to all of you. I seek your permission to speak to you sitting because of my difficulty in standing for a long time. I must apologize to you more than one count. On more than one count. One is the change of date, and the other is my inability to make available any printed material in advance or even today. And thirdly, though I am stated to be the course director, my understanding with the chairman of the regional council was that I will only select the topics from out of which the SARC can select, and also select the paper writers. But I only told them that if there is any difficulty in finding a person, you can put my name. So I am a standby. So with the result that I was informed that on 2 subjects they are not able to fix the person, and they informed me, but thereafter I was to go to many places. I was not in the city at all, so which prevented me from both adhering to the schedule and also in applying my mind to put my thoughts into writing. As a matter of fact, till 1 o'clock today, I could not even brush my memory to identify what I want to talk, and I forced myself a half-day holiday from the office to just go through my subject to identify the issues for discussion. Therefore, I request your permission that I speak extempore. The subjects which were chosen in consultation with the chairman was to the effect that we should try to choose a subject which will concentrate on a narrow area, so that there will be enough discussion and for the faculty to focus his attention on a narrow area. So that is why some of these topics have been chosen, and so far as the 2 topics which has been requested to be dealt with by me, the one which I am going to speak today, what is concealment? Normally the subjects in this regard will be penalty for concealment or penalty under section 271(1)(c). So penalty comes first, concealment comes later, with the result that lot of concentration is on penalty and less concentration on concealment. So I thought, well, let me remove the word penalty. Let us focus on the word only concealment. I felt that if one can seriously consider and focus attention on the word concealment, we will be able to identify the issue when a particular taxpayer is confronted with concealment. The word concealment is freely used and we understand. But the only drawback is that the term is not defined in the Income Tax Act. The so-called definition is with respect to items which are not concealment, deeming certain things as concealment. So that is the only thing which is in the Act. And if you go through any textbook, however big it is, there is no write-up on what exactly is the meaning of the term concealment. Many of the textbooks only produce the dictionary meaning, saying hide. Other than that, there is no descriptive expansion of the term conceal. Now, the way in which we understand the term conceal has to be with reference to what exactly is the requirement under the Act. I will give one illustration. Most of you are familiar with attending entertainment program like drama, where the audience is on one side and actors are on the other side, and frequently the screen comes in between, with the result that the audience cannot see what is happening on the other side of the screen. It is hiding. You are not able to see. And frequently the screen is removed, then we are able to see. Here also, everything is known, but one side does not know what is on the other side. In other words, the taxpayer is behind the screen and the department is before the screen. So the department does not know what is happening behind the screen, but those inside the screen know what is happening. So assessee knows everything about it. It is not concealed. He knows everything. But department does not know. Therefore, the term conceal is used. So everything is visible. So when everything is visible, why should there be a concealment? Everything is visible to the taxpayer. This is the thing which we are not able to understand. Why, in spite of the fact that taxpayer knows everything, that his income is this, his asset is this, and the requirement law is this, why this should happen? So, the subject of concealment starts from the first day when a transaction takes place, or when an assessee starts a business, or when any financial transaction takes place. Therefore, the point of time when concealment is said to take place is the period long before the filing of the return. So, if some care is taken to see that the screen which we are now visualizing in the case of a entertainment program is avoided, there can be no scope for any concealment. The reason is very obvious. The tax law is somewhat cumbersome, more complex, very difficult to transcribe with respect to the viewpoint of the tax gatherer and the viewpoint of the taxpayer. Therefore, in spite of your being very learned and you are being able to prevent any way by which a concealment takes place, because of the complexity, concealment comes into play. So this is why this subject of concealment is of great anxiety to taxpayer. Whenever a person files a return, as the statute requires him to file, the fear of concealment is in the mind of a taxpayer. Supposing a person does not file the return at all, is very happy in not filing the return. No, there is no fear of concealment. So the starting point of concealment is the time when you file the return. So if you take proper care in filing the return, the scope for getting into the area of concealment declines. It is therefore very necessary for a tax consultant, while preparing the return, or for that matter while finalizing the balance sheet at the end of a stated period, that they should apply his mind as to what are the areas where possible difficulty would arise in respect of concealment. The taxpayer will normally not reveal to the tax consultant as to whether he is disclosing all transactions which are required to be disclosed, or all transactions in which income results. It is therefore necessary, when a tax consultant is filing the return, to bring to the notice of the taxpayer that it is his duty to disclose correctly the income. Now at this stage, the taxpayer says, if I disclose the correct income or the appropriate income, the outgo will be very large. Therefore, I would like to see that I offer something which is affordable to me, or which in my opinion is affordable. Now it is then that there is an element of formulating a method of computing your income less than what it is. Now at this stage, when he wants to do it, you would like a planning in respect of computing his income, first in a legal manner. So the first exercise is planning, not after the year end, but even during the year end or at the commencement of the year, to formulate methods of planning to reduce your income in a legal manner. Now when you do that, you presume that you are able to bring about a reduction by following these statutory provisions. Now the question, insofar as that issue is concerned, whether in applying the statutory provisions for computing a lesser income than otherwise it would be, whether you are running into a situation of concealment. That is, you are following the statutory provisions, you are computing your total income, which according to you is permissible. But when the scrutiny of the assessment takes place, there is objection by the department that your computation by utilizing the provisions of the statute is not correct. What is called a wrong claim or an incorrect claim. There is a difference between the income computed by you and the income assessed. Now, is that concealment? Is the difference between the income returned and the income assessed on the basis of not accepting your claims? For example, there is a claim under 80 HSC, there is a claim under 80 IB. There are so many claims, even bad debts, so many things are there. Now, can you say that there is a concealment with reference to the income returned by you? Now, this aspect has been considered by courts of law, but the more you read of decisions with respect to this, the less learned we are in advising as to whether there is concealment or not. The fact is that courts of law always try to see the quality of the claim. The quality of the claim is the concept under which the wrong claim is considered as concealment. For example, you are not exporting any product at all, assume, or your export is only on the basis of some wrong understanding of the term export, and you claim 80 HSC. The claim is under the proper provision, but if you see the quality of claim, it is not qualitatively correct. So, even though it is a wrong claim, though courts have held that a wrong claim is not a concealment, but if the quality of the claim is looked into, then notwithstanding that it is a pure difference of opinion in respect of a claim, penalty is possible. Now, the reason which is attributed to this type of situation of concealment is as a result of certain decisions of the Supreme Court, though not under the Income Tax Act, but under Parallel Act, where the Supreme Court observed that concealment is not to be judged by seeing the circumstances under which the act has been done, what is called the intention. It is a pure error in respect of the statutory provision that will attract concealment and consequences of concealment. So, this is a very difficult situation created by the Supreme Court, and as a result, possibly even in our institute there were specific meetings on that as to whether the rule established by the Supreme Court in an enactment under the Central Excise rules, and if applied to the provisions of the Income Tax Act, as the Supreme Court itself has referred it in a subsequent income tax case, as to whether concealment is a pure arithmetic and has nothing to do with the quality of concealment. Subsequent to these two decisions of the Supreme Court, similar cases came before other forums where the department stated that it is not necessary to establish that the intention behind the claim, or as the case may be, non-disclosure of income, is not based on intention. Still, on a mere difference of the income returned and the income assessed, penalty is a must. Fortunately, some of the courts, of course not the Supreme Court, it is yet to be decided, they have felt that the rigor of the concept laid down by the Supreme Court, the case is Dharmendra Textiles, need not be applied to cases arising under the tax law. So a mere difference in a claim of deduction per se, so long as the quality of deduction claimed is proper, may not be treated as concealment. This is so far as statutory provisions are concerned. Now, when we travel beyond the statutory provisions as the filing of the return, today there is a lot of improvement in the method of filing the return. Earlier, some years ago, you have to file the return physically, enclose all the documents, give all proof or other data in support of a return. Today, a vast majority of the returns ought to be through e-filing. Of course, the e-filing format is itself very difficult to fill up, because the conventional way of drafting the profit loss account and computing the total income is totally different from the columns given in the e-return. No disclosure is being made in the e-return, either to explain or to say why you have omitted something. Those returns are in most of the cases accepted as correct, excepting when the case is taken up for scrutiny. In cases where e-return is filed and the assessment is not taken up for scrutiny, the issue comes only where a survey takes place or a search takes place, and the department tries to compare the data furnished in the re-return to the material obtained during survey or during search and seizure. Now let us take survey cases. Possibly most of you may be feeling the impact. As per the instructions of the higher ups, the department has been following up all assessments related to survey with concealment, where during survey a taxpayer agrees to offer an income and subsequently files a corrected return if it is for a previous year ended before the date of survey or in respect of the year of survey. So he makes a voluntary acceptance of error in the disclosure of income. For a long time, these acceptance were accepted in good faith, and they were not regarded as concealment requiring consequences under the Act. There are also cases where such declarations of additional income were supported by a request that no penal action be taken, and department agreeing to accept such declaration. But even in earlier times, when such declarations were given but not accepted by the department for various reasons, and where the consequences of concealment, penalties were levied and the matter was taken up before higher forums, the taxpayer submitted that he would not have offered voluntarily the income if he had not been assured that consequences of concealment will not be there. But you will always find that all these are one-sided. The department does not accept that there will be no penal consequence. A theory of holding out was placed before the court, that the department, having held out its arms, cannot go back and say, I will follow the consequences of concealment. But this was turned down by courts of law, saying that the tax gatherer has no power to grant amnesty for a person who offers income voluntarily during or after survey, and that the statute has to be applied wherever concealment has been noticed. Therefore, it drives the taxpayer not to purely rely on the request to condone the declaration of additional income as not concealed income. He has to defend himself on merits. Now, how to defend himself on merits when he makes a voluntary offer of income during survey? Now, there are two ways in which things happen during survey. The survey party notices certain defects, and finding that there may be further probe, the taxpayer abruptly offers an additional income without reference to any of the errors or material found out by the such party or survey party. In such cases, courts have taken the view that the declaration of additional income is not based on strictly any material observed or found or error or mistake located during survey. And based on that, even though penalty was levied, because penalty cannot be waived by the tax gatherer, because he has no such power under the present dispensation. He has no power. Only the Commissioner of Income Tax has the power to waive or reduce penalty. The assessing officer has no such power, and therefore he levies penalty. But in further proceedings, courts have taken the view that if admission of income during survey voluntarily over and above what has been returned, then factually there is no concealment because no material was unearthed disclosing that any income has been suppressed. But where, if material has been found, mistakes are located, and based on that a declaration is found, courts of law have found that such declaration of income will be visited with penalty because there is concealment deducted by the department before offer of additional income. Now, at this stage I will just transgress. As a taxpayer, I suddenly think that based on surveys taking place at many other places, I should secure myself and immediately file revised return wherever it is possible, and where the time for filing revised return has expired, make a disclosure by way of a letter either to the commissioner or to the assessing officer saying, I have omitted, I am now declaring this income, I have also paid my tax. Now, is this act disclosing concealed income? Voluntary, no survey is taking place, but similar surveys are taking place at other places, so he is having a fear that he may also get into the survey trap, therefore he files voluntarily. This is one area where voluntary return takes place. Second, where an investigation takes place at one place and this third party comes to know of investigation taking place in the other place, knows that certain transactions have been done which are not legitimate, and before the department comes to him based on the investigation on the third party, goes voluntarily, either files a revised return or makes a declaration of additional income, pays the tax. These are all two broad examples. Now, is it concealment? Or can the taxpayer advise, the tax advisor advise the taxpayer, please file the voluntary return, you will be safe. How safe he is? By filing a voluntary return before any direct action is taken against the taxpayer. Now, this particular aspect was considered in one of the decisions of the Supreme Court, that a mere filing of a revised return or a mere offer of declaration of additional income not disclosed in the original return is not an act which should go unpunished. It's a very far-reaching decision of the Supreme Court, because it is no different from a person who pays a tax correctly and a man who doesn't pay the tax correctly but tries to compensate it subsequently, fearing some action. So Supreme Court was very harsh. It said, no, don't leave him. Doesn't matter whether he does it voluntarily, doesn't matter whether he does it out of fear, penalty is a must. Now, can the tax advisor advise this person, no, please file it, you will be in danger. Now, the correct method of dealing with such a situation is to see in the Income Tax Act whether the assessing officer has the power to condone your action and to waive penalty or other penal provisions. You will see there is no such power. An assessing officer has no power to waive where a revised return is filed. So the only authority who has the power to reduce or waive penalty, provided all the conditions are satisfied as set out in the statute, is the Commissioner of Income Tax. So the advice in such cases should be to present a petition before the CIT detailing the circumstances under which the voluntary return or a revised return offering higher income is filed, and stating that it is being done without the department finding it out, and paying both the tax and interest, and requesting the Commissioner to exercise his power to waive or reduce. Now it is a risk you are taking, because the Commissioner is a human being who has got all minus and plus qualities of a human being. So he may waive or he may not waive. He may reduce or he may not reduce. So how can you judge the Commissioner like a coconut? Can you find out? No. You cannot tap his head and find out what is in his mind. Maybe he may waive or he may not waive. So what is the alternative? Can you take a risk? If it is 50,000 rupees, you can take a risk. The burden is not very heavy. But supposing it is 10 crores, supposing it is 50 crores, will you take a risk? Even the Commissioner will not take a risk. Therefore, what to do? I want to solve the problem. Concealment is there but not found out. I am in fear complex.